look, when you enter the options market, you have a lot of opportunity, but let's be honest, it's a little bit complicated. It's complex. There are so many moving parts, and it can be quite overwhelming, specifically when it comes to the plethora of strategies. Stock traders have it very easy. If you're bullish, you buy the stock. That's it. You only have one thing you can do to express your bullish opinion. If you're bearish, you short the stock. That's it. Like one choice. So it's binary. Either you like the stock enough to buy it, or you like it to the downside enough to short it. That's it. Like there is no strategy matrix. There is no framework you need to make a decision about what to do when you like a stock or dislike a stock. But the options market is different. You have dozens and dozens of different strategies, which presents a lot of interesting opportunities and allows you to be more specific with the way you go about placing trades. But it's, it's complicated. It's like going to a buffet. You have all these choices, and knowing which one to pick can be tricky. So the aim today is to teach you about how to create a strategy matrix, which will help you make better decisions about when to use which strategy, because they have different characteristics and there's a time and place for every strategy ultimately. We have written quite a bit about this. We have a newsletter over at Trading Justice that I'm going to reference here in a second that walks through how I build a strategy matrix. I want this to be like a 10-minute version of that newsletter and help you see the thought process that goes behind this. So the first thing that you have to understand is you have really two key variables when you are trying to pick a strategy in the options market. Okay, so to be more specific here, let me put options strategy matrix. First, you have what is your directional bias? And as a stock trader, you think, oh, that's bull or bear. Yeah, that's part of it. That's part of it. Bull, right? Bull and bear. But you also have neutral. So neutral becomes a potential bias in the options market because there's ways to profit when you have a neutral opinion. So bull, neutral, bear. We could even go one step further and say bidirectional. What's bidirectional? Well, bull is the opposite of bear. What's the opposite of neutral? What's the opposite of thinking it's going to go sideways? The answer is bidirectional, thinking it's not going to go sideways, thinking it's going to go either up a lot or down a lot. You could leave it at that, but if you want to go one step further with your expression of whether I'm bullish or bearish, this is something we do at tackletrading.com to provide some specificity, to get a little more granular. We actually split bull into 3 shades of bullishness. You could be aggressively bullish, you could be maybe moderately bullish, you could be mildly bullish. And we use numbers to express that. 3 is aggressively bullish, 2 is moderately bullish, 1 is mildly bullish. And then on the bear side, you could be aggressively bearish, -3. You could be moderately bearish, -2. You could be mildly bearish, -1. These numbers just allow us to be a little bit more specific as we discuss, our opinions, because, there's lots of different ways that you can try to trade being bullish. And so it's nice to know, like, how bullish are you? Do you think the stock's going to go to the moon, or do you just think it's going to go up a little bit, right? Neutral would be 0. Bidirectional would basically be the extremes. I either think it's going to go up a lot or down a lot. Okay. So you can see, oh, this gets complicated quickly. Stock traders up or down. The options trader, I just gave you like 7, maybe even 9, arguably, 8. 8 different opinions, right? 3 bulls, 3 bears. Let me do it this way. 3 bulls, 3 bears, and then neutral and bidirectional, right? So I actually think you could have maybe 8 opinions. And incidentally, you can build option trades that are specific to each of those 8 opinions, right? More on that in a second. The other variable that matters when you're picking an option strategy is implied volatility. And we've talked about implied volatility here at Jedi Options. The simple answer as to what this is, or the definition, it just tells you if options are cheap or expensive. Are options cheap or expensive? Because you can both buy them and sell them. And in some situations, you want to sell them because they're expensive. In other situations, you want to buy them because they're cheap. So you have to say, hey, do you think implied volatility is low, which means you're essentially bullish on implied volatility, you think it's going to go up, or do you think that implied volatility is high? Right, IV is high, which essentially means you're bearish, you think it's going to go lower, or you're just of the opinion that options are expensive, right? Using those two variables with their subsets, bull, neutral, bear, bidirectional, IV low, IV high, you can create kind of a matrix. Think of a table with different sections where you could basically say, hey, if I'm bullish but IV is low, this is what I do. If I'm bullish and IV is high, this is what I do. So to visualize this, I've already kind of drawn out, because I know time is of the essence, already drawn out my table here, and I've put some strategies over on the right. Okay, so this is like my list of potential strategies. This is my options buffet. I've got all these choices, and how do I narrow it down, right? How do I choose? Well, I can use this matrix, this strategy matrix. So you've got direction, that's going to be the rows, and then implied volatility is the columns. And if you did this in a spreadsheet, you would basically have two columns, low and high, right? And then you have a bull row, and you have a neutral row, and you have a bear row, right? So I could basically connect these all and do something like this, right? So I'm just going to deal with the internal part of it and not the outline, right? So let's plug and play here, okay? Let's think through this. Long call. Well, is that bull, neutral, or bear? It's bullish, right? So I know I'm dealing with the first row with the long call, okay? So then the question is, does it go here or does it go here? When I buy a call option, do I do that if options are cheap or expensive? Low IV means options are cheap. High IV means options are expensive. I'll give you a hint. If you are buying something, if the strategy involves a debit where you are paying money to enter, odds are you want options to be cheap, because the cheaper they are, the less you have to pay. The less you have to pay, the less risk you have. So a long call is ideal in a low IV environment. So long call would go right here. Okay. All right, there's the long call, done. How about a bull call spread? Bull call spread is very similar to a long call. You're bullish. It's in the name, for heaven's sakes. You're in the bull row. And do you want options to be cheap or expensive? Well, this is a debit trade. You pay money when you enter a bull call spread. So this goes under low IV, bull call would go here. Done with that one. Okay, how about, let's mix it up a little bit here. How about a bear call spread? How about a bear call spread? Well, for heaven's sakes, it says bear in the name. Do you think it's a neutral trade? No, it's a bear trade. Okay, so it's either going to be here or here. Well, do I want options to be cheap or expensive when I do a bear call? You may not know this. I'll just tell you, it is a credit spread. You get paid money when you enter a bear call. You're selling a call vertical spread. So do you want to get paid a lot of money, or do you want to get paid a little bit of money? I want to get paid a lot. I want options to be expensive. So the bear call is bearish, and you'd like to have higher IV, right? So it's going to go right here. Bear call. Okay, that one's done. Now I can go through every single one of these, and I can place them where they go. For sake of time, let me just cut to the chase. A long put, you're bearish. You're buying an option. You want it to be cheap, so you want low IV. All right, done with that. I mixed up the bear call and the bear put. The bear put is a bearish trade, duh. And you want it to be cheap because it's a debit spread. You're paying for it. Cheaper the better, so that goes here. Bear put. Iron Condor, this is a neutral strategy, and you're selling options. Do you want the options you sell to be cheap? No, I want to sell crap that's expensive. So I want the IV to be high because that corresponds with expensive options. So right here would be the Iron Condor. Okay, done with that one. How about a bull put spread? Well, it's bullish. Okay, come on, people. Bull. Do you want options to be cheap or expensive? I don't know. Are you buying or selling them? You're selling them. A bull put spread's a credit spread. So you want options to be expensive, high, IV, in other words. So I got a bull put. In case you're curious, this is where a naked put would go. It's also where a covered call would go. Poor boy's covered call is neutral to bullish. So this is where it gets tricky. Sometimes you have two biases where you make money, but if you had to pick one, really you are bullish on a poor boy's covered call. And this is a debit trade. You're paying to enter this thing. So it is low IV. You want options to be cheap. So you start to see how if, you don't have to have a comprehensive strategy matrix that includes every single strategy, but if you just take the time to list out the strategies you like, the strategies you know how to trade, and then just think through bull, neutral, bear, low IV versus high IV, you can customize and kind of create your own little strategy matrix. Eventually, you'll just have all this memorized. But it's helpful for decision making so that when you go look at Tesla, when you go look at Microsoft or any stock, and you analyze it and you say, oh, I'm neutral on this stock and implied volatility is high, I can go right to my strategy matrix and I can say, oh, iron Condor, right? That's the potential strategy that I want to use for this situation. And you could even take it one step further. Again, I said bull, you could have three different, aggressively bullish, moderately bullish, mildly bullish. Well, in the matrix I just drew, there was just one bull. What I try to do is I'll just put a number by each one. Like long call would be a 3. That's really bullish. Poor boy's covered call, that'd be more like a 1, mildly bullish. A bull call is more like a 2, moderately bullish. So see now, I can not just say, well, I'm bullish and IV is low, so I got 3 choices. Well, but how bullish are you? That can help narrow it down as to which one of those 3 you pick, right? On the bear side, if you buy a put, that's really aggressive. Do a bear put, that's more like -2, right? And so then what ends up happening is your matrix, go the distance on this, your matrix will look something like this. Okay. And this is kind of a completed version with a whole bunch of strategies thrown in there. But look at how much easier it is now for me to make decisions without being overwhelmed, right? And yours doesn't have to have 15 strategies. It could be 3 or 4. But ultimately, this is really what differentiates somebody who's just starting options and just feels overwhelmed versus somebody who has a pretty good grasp on when to use which strategy. And it's not that you're going to be right every time. Sometimes you're wrong, but it at least helps you have the tool you need to pick the right strategy for the right time. Final thing, if this idea intrigues you and you're like, man, I want more on this. Well, if you go back to the Trading Justice website, January of this year, the definitive guide to option strategy selection, you'll get some more context around how you know what your bias is on the stock and IV. And this is where you will see that strategy matrix that I just showed you down here at the bottom.